The stock market is falling, and most investors are doing one thing right now. They are selling. But I am doing the exact opposite. Over the last few weeks, the entire stock market has been bleeding. The S&P 500 is dropping. Your favorite individual stocks are down. And the financial news is absolutely terrifying. When you see those negative numbers day after day, a very specific psychological reaction kicks in. The temptation to hit the sell button is overwhelming. You want to stop the bleeding, you want to move your money to cash, wait for the dust to settle, and maybe buy back in when things look safe again. But if you do that, I believe you are making a massive mistake. In my experience, the market is not crashing because the global economy is suddenly broken. It is crashing because it is terrified of geopolitical headlines. And historically, when the market panics over temporary headlines, it creates the absolute best buying opportunities for long-term investors. In this video, I am going to break down exactly why this market crash is happening, what to expect in the coming months, and why I'm officially changing my strategy to buy heavily into this panic. But first, welcome back to Rebuild Finance. This channel is about documenting a long-term investing journey, building a portfolio step by step, and sharing the real analysis behind each decision. My goal is simple: find elite businesses and broad market index funds, buy them at fair prices, and hold them for the long run. If you enjoy this type of content, make sure to subscribe. So let's ignore the panic and look at the real situation. To understand why your portfolio is dropping, we need to briefly look at the news. As you probably know, tensions between the United States and Iran have escalated dramatically. The market hates war, but what the market hates even more is uncertainty. A few days ago, we saw a perfect example of this. President Trump issued a strict deadline. The market was holding its breath. Then, over the weekend, Trump posted a tweet stating that there were good developments happening behind the scenes. The market algorithm instantly reacted. On Monday morning, stocks rallied hard. Investors thought a diplomatic exit was secured and the worst was over. But that relief did not last. Shortly after the rally, Iranian officials completely denied the claims. The result? Absolute chaos. The market realized it had been faked out. The uncertainty returned and stocks violently crashed back down, wiping out all the gains. This whiplash is exhausting for retail investors. But as long-term investors, we cannot trade based on daily political tweets. We need to look at the underlying economic mechanics. Because the real threat to the stock market is not the conflict itself. The real threat is what the conflict does to inflation. In this situation, the real problem is oil prices and inflation. Historically, the stock market becomes numb to geopolitical conflicts very quickly. The initial shock usually fades after a few weeks or a couple of months. But what the market actually cares about are the economic side effects. And in this case, the side effect is the price of oil. Because of the tension in the Middle East, crude oil has spiked significantly. And oil is the lifeblood of the global economy. When oil prices stay high, the cost of manufacturing goes up. The cost of shipping goes up. And eventually, those costs are passed down to the consumer. Over the last year, we finally saw inflation cooling down. But now, with oil prices surging, Wall Street is terrified that inflation is going to rip higher in the coming months. If inflation goes back up, it means the Federal Reserve cannot cut interest rates. Higher interest rates make borrowing money expensive, which hurts corporate profits and destroys stock valuations. This chain reaction from the Middle East to oil to inflation to interest rates is exactly why the entire stock market is currently selling off. But here is why I am not selling, and why I see this as a massive opportunity. The market is currently pricing in the absolute worst case scenario. It is assuming that oil will stay high forever and that inflation will permanently ruin the economy. But what if this conflict is resolved faster than expected? If a diplomatic resolution is reached in the near term, the geopolitical fear vanishes. Oil prices will collapse back to their normal levels. If that happens, the inflation scare disappears with it. The damage to the economy is contained before it even truly begins. And this leads us to the most bullish catalyst possible. If oil drops and inflation normalizes, the central bank finally gets the green light to aggressively cut interest rates. A stock market rebounding from a geopolitical crash combined with a Federal Reserve cutting interest rates is absolute rocket fuel for equities. The stock market is a forward-looking machine. It will not wait for an official peace treaty to be signed. The moment the trend shifts, the market will gap up so fast that anyone sitting in cash will completely miss the recovery. If you're still feeling hesitant, I want you to remember what happened just a short time ago. Think back to the crash after the massive new trade tariffs were announced. The market experienced a violent drop. The fear back then wasn't the Middle East, it was a global trade war. The headlines were terrifying. Financial news channels were screaming that the economy was going into a recession. Every human instinct told retail investors to sell their stocks and hide in cash. But what happened next? The people who ignored the noise, the people who kept investing despite the tough situation, made incredible gains. The market eventually realized that great companies were strong enough to survive, and stocks rallied back to all-time highs. We are seeing the exact same psychological pattern play out now. When you buy a broad market ETF, or when you buy shares of elite companies, you are buying a piece of human progress. Do you really think a temporary spike in oil prices is going to permanently destroy the global economy? Of course not. The only difference is that now, because of macroeconomic fear, Wall Street is offering you a chance to buy these incredible assets at a massive discount. That is why I'm officially changing my strategy this month. Instead of pacing my investment slowly, I'm actively deploying my cash reserves into the market right now. I'm not trying to catch the exact bottom because nobody can predict the bottom. But I know that buying high quality assets during periods of maximum uncertainty is the only proven way to generate long-term wealth. So, if your portfolio is red now, take a deep breath, turn off the news, do not panic sell. Treat this whiplash not as a disaster, but as the buying opportunity it truly is. Now, I want to hear from you. Are you using this market crash to buy more stocks, or are you moving to cash to wait for the dust to settle? Let me know in the comments down below. If you found this logical, numbers-based approach helpful, please hit the like button. It really helps the channel reach more investors. And if you want to see my 3 stock picks for March, click on the video on your screen. Thanks for watching, and I will see you in the next one.